Hello, everyone. Today on the final bar, my guest is Doug Busch from ChartSmarter. I'll throw a couple names at you with some interesting setups. Right now, you have the market back in recovery mode. I guess things are fine after yesterday and the day before really capitulating, right? Really distributing into the close. Today, you get a pretty healthy bounce with a lot of names in the afternoon after weaker in the morning, really going back to the upside. We're going to focus a little bit on sentiment today. Thursday, Wednesday, you get a lot of sentiment reads. We'll update on the latest readings and what that means for the big picture. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in sunny Redmond, Washington. Thanks for joining us every weekday after the close as we make sense of these markets together. Focus on the message built into the markets themselves, the message of price. I did some interviews earlier today for our second season, which we're shooting now for Behind the Charts. It's where we dig into the background, the stories behind some of the top chartists and technical analysts. We spoke with Michael Kahn from Lowry Research earlier today. Also, Bruce Frazier, host of Power Charting and a lifelong White Coffeean. It was the consistent theme in those two conversations was the message of the markets themselves, to keep it simple, to focus on the trends, to focus on supply and demand and how that's represented by the stock price. The best thing you can do to get a sense of what's happening with the particular stock, I would argue, is look at the price and see how things have evolved and understand the trajectory based on fear and greed, supply and demand, all of the above. We have great guests on the show. Doug Busch from ChartSmarter is one of my favorites and a fantastic stock picker, and always brings a couple charts that I jot down. I usually make a point of jotting down because I want to dig in a little deeper. Next week we have David Auerbach from the Daily REIT Beat coming on Tuesday. On Wednesday, JC O'Hara from MKM Partners in New York. And then on Thursday, we have Matt Tuttle. Matt's the founder of Tuttle Tactical, and the creator of ETFs like SPAC and FOMO. So it should be a lot of fun to talk with him next week. We will be taking next Friday off for the Good Friday holiday. And then that whole next week, the final bar will be in my guest hosts' hands. We have people like Aaron Swenlin, who else? Grayson Rose, Julius DeKempener, Greg Schnell have all agreed to come in and host an episode apiece. So it should be a lot of fun. You'll get a lot of different perspectives on the final bar, and then I'll see you after that. Let's get to our market recap. As I mentioned, this is a very different feel today versus what we've seen in previous days. I mean, literally, as we're getting set up for the show here, I'm seeing small caps continue to bounce back to the upside. Now, small caps got absolutely crushed yesterday, and it accelerated into the close. A lot of things rolled over in the last hour. Small caps were down pretty much since lunchtime, just sort of fell off a cliff and continued. That continued this morning. So early this morning, first hour or so of trading, it felt like just this continuation. And then a huge bid came in, and stocks sort of have not looked back through the course of the day. The S&P 600, the small cap index closing right around 1,300. That's up 2.6% from yesterday's close. Now, again, let's keep this all in context. That's still below yesterday's open, but it is a nice bounce higher from where we were looking about 24 hours ago. So let's give it credit there. The S&P finished around 3909, about 0.5% higher than yesterday, and again, sort of spent the first half of the day in the red, and then the second half recovered and pushed higher. The Nasdaq actually finished in the green. The Nasdaq Composite, Nasdaq 100, not quite, finishing off a little bit from yesterday, but again, after a series of down moves, that's not bad. And the VIX is holding steady right around 20. Other asset classes very quickly. 10-year yields essentially flat. They were higher in the early afternoon, but came back and settled in about to where they from where they closed yesterday. The dollar a little bit stronger, the TLT down. Gold and silver mixed today, with gold down 0.33%. Commodities as a whole weaker, with energy prices going lower. The XLE was up a little bit, but not much relative to other sectors. Bitcoin actually flat, and a 0% return on Bitcoin 0% change. I'm hitting the monitor thinking there's got to be something wrong because that's never happened, but it apparently did. We around 52,300, right about where we were 24 hours ago. So not a huge change, sort of mixed otherwise, but I would say overall net positive. Let's look at a chart of the S&P 500, make sense of what's happened today if we can, and then we'll continue on with some other charts to review. So here's the S&P going back to the March 2020 low, and we can see the overall uptrend we've been in, just a nice positive trend overall with some hiccups along the way, but overall has continued to resolve to the upside. When we looked at the close yesterday, we closed at the lows of the day, the 50-day moving average, not too far below where we're at. My thinking was this looks a lot like some of these previous pullbacks. Now, one of two things obviously could happen. One, we find a bounce off of that low, just like we did at the end of January, just like we did here in late February, just like we kind of did here at the beginning of March, where you closed down one time, but then didn't even undercut that low again, right? You sort of rallied from that point on. So are we in a similar situation where we test the 50-day? Now, here's the challenge with thinking today's move kind of clears the table and we're off to the races and going to make a new high any moment. The market should, and often does, if not always does, bounce off the 50-day moving average. So many people consider that a key line in the sand, a key level to evaluate the risk. You can see that back here in mid-September of 2020. We pulled back pretty quickly down to the 50-day and then bounced off. You had a couple days of higher move before you sold off and kind of got back down to that 3,200 level. And that's where things you really had to think about the overall risk and versus reward and what you might expect. So it's totally fair in either scenario. If you're bullish or you're bearish, I would argue you're probably very validated by today's move. Because if you're bearish, that's totally reasonable. You'd have a bounce after yesterday's sell-off, after 2 straight days of accelerating into the close. That's reasonable. And if you're bullish, you feel like perfect. We found support at the 50-day and we're going higher. I don't know I think I would argue it's 100% too early to be making that decision based on the last couple of days. I would say it's reasonable to have a bounce off the 50-day. I still think there's more distribution that is going to happen here in the coming weeks and months. And the main reason why I would argue that are the series of bearish divergences we've been talking about for a while. I can't help but notice that every time in 2021, when the S&P makes a new high, it's on lower momentum. That's not what a sustained bull move tends to look like. That's more what the end of a bull move, starts to look like. We have waning momentum in the later stages of that. And as we looked, I think I don't want to beat a dead horse out after yesterday. I think we spent some time going through some of the divergences, but we've seen plenty of divergences on semiconductors about a month ago, and now you're seeing it in a lot of places, including cryptocurrencies, things like Bitcoin, that are sort of giving that bearish divergence. But again, all of that is less important than do we hold these swing lows? Do we hold support when we roll over? And with a lot of the stocks that have come off that look a little weak, I think that's what I would certainly be looking for. Let's go back to what happened today and see what other themes we can tease out. So the top sectors today, 3 of them at the top of the list, and then it was sort of everything else. Financials, number 1, industrials, number 2, materials, number 3. At the bottom, you only had a couple sectors that were down. And not surprisingly, I would argue, given the rotation out of growth and into value overall, we see communication services down about 0.5%, technology down just a little bit below the zero level, essentially flat for the day, and energy up a little bit, but not nearly as much, sort of underperformed the overall market today. In terms of some of the key group movements, and we will touch on sentiment a little later. A lot of sentiment numbers have come out and some euphoric signals I think we want to review. But in terms of things that are working, steel stocks up pretty good. Names like Nucor and others. Airlines, number 2 from the top. And you're noticing a number of consumer discretionary furnishings, home construction, that's all the home builders, travel and tourism, recreational services, even transports, all in the top 10 here. So a nice sort of reopen theme to a lot of things with infrastructure plays, home builders, travel names, sort of at the top of the list here. We'll come back to a couple of those in a minute. Worst groups to be in, software, that's Microsoft's group, if I remember right. A lot of materials, in particular gold miners down here at the bottom that, if you look at a chart of the XAU, it's not been great. And that's because of weaker gold prices. I would argue I've sort of put the contrarian bullish call out on gold. I think it's pulled back to the point that you could see something like that working, but it's not the chart that I normally like to go into. I'd much rather own something that's working than something that has not been working. But it's tempting on something like gold that has retraced so much from where it's been. And then footwear at the bottom, that's something like Nike would be in that group. Let's look at a couple of stocks here ahead. Hog up earlier, Harley Davidson with a nice bounce higher, closing up. It was up about 6+%. It closed just below there, but I was so excited to highlight a bullish engulfing pattern. We don't have a lot of those recently. We've had a lot of bearish engulfing patterns that I've highlighted as things kind of roll over from the top. This is what a bullish engulfing pattern looks like, which is a down day yesterday. We close near the lows of the day. We open lower and then we close above the previous day's open. If you're a bar chart user, you call that a bullish outside day, and the conclusion in either case is pretty similar. It tells you to expect a tactical bounce. Next couple bars more likely to be higher than lower. And Steve Nissen, who I spent time with earlier in my career, was an expert in candlestick analysis. Always talked about using the highs and the lows of the pattern as key levels. So if we would break the low of today, which is the low of that bullish engulfing pattern, that would sort of negate that bullish short-term sentiment that you get. But interesting to see a name that bounced really highly off a relatively weak level there. Looking at airlines again, they're all bouncing off of relatively weak levels. Yesterday and the day before, you had a lot of these rolling over. This is American Airlines, AAL. So it had just broken above 25, touching 26. This is finally getting above the June high, and then it's rolled right back down. You call that an island reversal. We have a gap up, have this consolidation and a gap down, a nice bounce higher, finishing over 50% of the way up through yesterday's candle. So that's sort of a short-term bounce, but overall, I think it's a really important chart to watch. See if we continue to make higher highs and, more importantly, higher lows. If we continue to go lower, do we hold the 50-day moving average as support, as has worked a number of times in the last 4 or 5 months. That's our market recap. We need to take a quick break. We'll be back with Doug Busch. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's great to have you join us every weekday after the close as we try to make sense of these markets together using the power of data visualization, the power of stock charts and technical analysis. As a reminder, we'll do another mailbag segment on Friday's show. We would love to answer one of your questions on the air. Shoot us an email, thefinalbar@stockcharts.com. Look us up on Twitter @finalbarsctv. Or on our YouTube channel, just put a comment below the video that you're watching. No question is out of bounds. Anything about market structure, particular tickers, indicators, charts, whatever it is, we're happy to answer questions on the show. So shoot us an email if anything comes up in your own process. Also, as a reminder, the new Stock Charts TV on demand is live and ready for you. Go to stockchartstv.com, use your email, set up a free account. Also, you can find us on all the app stores, Apple, Android, Roku, et cetera, et cetera. I want to welcome on my guest to the show, joining us again, Doug Busch from ChartSmarter. Doug, I think of you as a talented and effective stock picker. You always bring some tickers that make me think that I tend to jot down. Thanks for joining us back on the show today.
Anytime. It's always a pleasure, Dave, and thanks for the compliment.
Of course. So we're looking at a sector that's relatively weak today. One of the weaker ones, communication services. You brought a couple charts that stand out to you. Start with TV. What are you seeing here?
Yeah, well, look, you did say the group is weak, but over the last 1 year period, it's still standing out pretty strong. So I think it's the fourth best out of 11. Many people attribute that strength to Google, which once again, actually, coincidentally, did find support at that round 2000 number today. But I'd like to take a look at a couple plays within, a couple international plays that, like you said, might not be on too many people's radars. I like to bring different names around. This one is Grupo Televisa. TV is the symbol. It's a Mexican media play. It's down about 5% this week, but the prior 2 weeks both jumped about 16%, believe it or not, in above average volume. You can see the break above that double bottom pivot of 913 back on 317. I like, if you can see there in the beginning of March, how it filled in that gap back from early November. Then it took that nice rise to the right as it did break above that 200-day. I'm a big believer in round number theory. If this could get through 10, Dave, I really think 13 comes fairly quickly.
That's a great chart. You mentioned the big round number thesis a couple times. This is interesting how I found resistance right at 10, and I totally
Yep.
hear it. A break above that, clearing the way for further highs. Chart number 2, CRTL.
Yeah, this one's a French advertising play. Rose 18% after a very well received earnings reaction on, I believe, February 10th. It's digested that move very nicely. Very taut trade, hallmark bullish characteristic. I really like when the charts do that. You can see just before that earnings jump, it broke above that 2258 cup base pivot. We know the best breakouts tend to work right away. Coincidentally, on a monthly chart, I know we don't have it here, but people want to go and look back. That 30 number going back to, I believe, 2014 was either support or resistance. Had its best monthly candle, best monthly gain last month in at least 7 years. I like this name on a little pullback toward 30. I'm not sure if we could get there. You don't really need to nickel and dime yourself. You probably buy it here and stay long above the 50-day.
Chart number 3, a name probably more familiar to many of us, New York Times. Talk through this one.
Yeah, this one, look, it's probably the weakest of the 3, but it's kind of bottoming here. I like it. It's about 19% off its recent 52-week highs, down about 5% heading into Friday this week. If that stays, it'll be the first 4-week losing streak in 3 years. A couple of things I like that make it a good risk reward scenario. You can see here it's finding support back at that cup base breakout around 47 from last December. It's coming into its 200-day moving average where it did find support last November as well. I think you could buy it in here, stay long above the 200. If strength materializes, you can see that there's a double bottom pattern here forming that you could add to later down the road. Of course, it still has some work to do before that.
You know, I'm noticing as you're talking through these charts, 3 great examples, and you're, at the bottom, you're doing the relative, but not relative to the S&P, you're doing it relative to the sector, right? Relative to the XLC.
Sure.
Can you just talk for a moment, we just have a minute left. Can you just talk about why you would look at it that way and what that does for you?
Well, I mean, I just want to see, like you, I always remember the quote I can't remember exactly, but you know what, if you're designing a portfolio, you want to put your best players on the field. You want to see who's acting well. Yeah. So this ratio chart basically tells me how that stock is actually performing against its rivals, its peers, if you will. So you really want to see, see names that are actually outperforming the group. Those are names I really look to. Those are the names you want to own. Those are the names with momentum, and you follow the trend.
3 great charts, and I really appreciate you talking through the relative strength play at the end there. Doug, thanks so much for coming back on the show. Stay safe. We'll talk to you again soon.
Thanks for letting me steal your quote.
That's Doug Busch from ChartSmarter. Doug does such a great job. He always brings tickers, again, as I mentioned, that make me think that. By the way, his quote that he alluded to, that he mentioned, my experience with that was with John Roque, who's a longtime technical analyst. He was at Natexis Bleischroeder, and then at a couple of buy-side firms, and just a really, really talented technical analyst. But he had a very laid-back way of approaching things, and pretty much half of our meetings would be focused on baseball analogies because he was a huge baseball fan. So we'd come up to Boston, always use the Red Sox or the Yankees as an example just to rile us up. And he would say, and I remember him saying, all right, listen, if you're managing a baseball team and you're trying to beat the New York Yankees, do you put your kind of okay players on there, or do you put your top players out on the field to try to win the game? And that was his argument for why you lean into the relative winners, why you focus on stocks that are getting it done. Your top performers, that's what you want to build a portfolio around. And I love that. I love that way of using relative strength to focus on what's working. And in general, if you own stocks where that relative line is going higher, overall, you're, by definition, doing better than sort of a passive play, right? So sort of, covering your eyes and just buying something general and passive. Great take by Doug Busch, and I appreciate him talking through those couple charts with us. Our next segment is called Getting Sentimental. So a lot of sentiment data, weekly data, comes out on Wednesday and Thursday. So it's always helpful to sort of see what the updated numbers look like, what that means for the big picture. We're going to use a chart list called Sentiment Indicators. If you don't have this chart list, or if you want access to it, If you go to the chart pack system, there's a group of charts called the David Keller's morning coffee routine or something like that. You can download this chart list. Pretty much most of the charts that I use on the show are all part of those chart lists that you can download. It's part of your StockCharts subscription. So check it out. You're welcome to download them and tweak them, use them however you like. We'll start with the VIX, and again, the VIX for me is less of a timing tool, but more of an illustration of investor sentiment, investor psychology. I'd love to think that it is super simple, that you just sell whenever the VIX hits 20 and that's it, and the market's topping. It's just not the case, and part of that is because the VIX is not range bound. It's not, by definition, it doesn't have a floor or ceiling besides maybe zero. But in general, it's years will have different ranges, dramatically different. So if you look back in 2009, the VIX in general ranged from about 10 to 12 at the lows up to about 20, 24 on the highs. That completely changed in the first quarter of last year. And since then, for much of the last 12 months, the VIX has been between 20 on the lower end and 40 on the upper end, 35 to 40. And if you look, the pullbacks that we've had when the VIX gets up to around 35 to 40, those have been really good times to buy back in if you were short or in cash, because these are the buyable dips within the long-term uptrend. And the problem is, the good thing is that has worked very well. The problem is it works until it doesn't, right? There, at some point, when we enter more of a bearish phase, that will be broken. That relationship no longer will work because the VIX could remain very elevated. It could go well above 40. And that's sort of what we saw in the beginning of 2020 is volatility just spiked to levels that we had rarely seen ever, right? I mean, these were extreme all-time high sort of values. But where are we at right now? I always think it's interesting to see where we're at, look to the left, see where we've been at those same levels and see what the market conditions are sort of like. We have a VIX around 20. We actually dipped below 20 for the first time since, that's right, the first quarter of 2020. This is the lowest reading that the VIX has been. So overall, volatility is at a relative low point. Previous times when the VIX has been around 20, the last time was at the February peak there in mid-February. Before then was in early December 2020, and then before then, August of 2020. So a couple of those times, pretty decent places, either right at a top or near to the end of a bull market phase or a short-term tactical bull within this longer-term uptrend. One of those times, December, was really more of a pause before we just resumed the uptrend, and volatility remained relatively low for the next 6 weeks or so. So it is worth, to me, noting the fact that the volatility is at the lowest point it's been for quite a while. We dipped below 20 right here at the peak a couple weeks ago. I think that could end up being a really important tell that extreme low volatility at extreme high prices can often be an exhaustion signal. However, it's all about price, right? And whether we're able to hold these swing lows on any sort of pullback, that is what we've not broken yet. For most stocks, aside, with removing something like semiconductors for that, which have already broken through the swing low, a lot of things have not. Next chart is the AAII survey. This is American Association of Individual Investors. It's a weekly survey asking what people think about the stock market, bullish, bearish, or neutral for the next 6 months. And it's tabulated every week. We got back above 50% bullish for the first time in quite a while. There have only been a couple times in the last 5+ years that we have had a reading, a bullish reading this high. November of 2020, December to January of January of 2018 will be the two other times we've done that. When I had Mark Young from Wall Street Sentiment on the show a number of times, I remember talking about the AAII survey and asking about what he thought. He's looked at the data much longer and much more deeply than I have. And his comment was the most important thing on this chart is the percent of bulls. And when the percent of bulls gets above 50%, you're now in the euphoric range. That's when you want to start looking for conditions of a market top. And so I think the distribution that we've seen this week with the AAII bullish reading above 50% for me puts us in the higher risk than maybe we've been previously of a significant pullback from here. So look for the warning signs, look for indications of internal weakness and breakdown. Also worth noting here at the bottom, the spread between the bulls and bears. There are 30% more bulls than bears because there are only 20% bears. And if you look back, I've put this little blue horizontal line here. You can see that's actually one of the lowest readings we've had at all over the last 5 years. It's an extremely low percentage of bearish response. So the spread between the two is one of the highest readings we've had. Again, the only other times we have been this extreme were in November, and then November of last year, and then back here in 2018. So the problem with this is, as you can see here, November was the strongest. This is when we had a huge blowout in bulls. It was almost 55, maybe a little bit above that percentage, one of the highest readings in history. That was just at this point before you continued and had the next couple months that went higher and higher. So again, for me, sentiment is third on the list. That causes me to go back and look at breadth and go and look at price itself. And those are the things that I want to follow to determine whether we are in an actionable bear pattern. In terms of the name exposure index, this is the National Association of, well, what is it? National Association of Active Investment Managers. I'd get there. It's the name organization, the name exposure index. You can say you are 200%, 100% long, 200%, 100% short, or flat. You're zero in the middle. And in average, it tends to fluctuate. Very rarely gets down to zero, although it has happened. It's gone below zero before, but very rarely gets above 100%, which would be leveraged long on average. Usually it's between 0 and 100 on average, and usually 50% or above in a bull market phase for sure. We're back to around 57%. So what's interesting is you'd had extreme high levels in the first eight weeks of the year, over 100%. So there's leverage long, and that really had started in November when you started getting that extreme bullish sentiment. So for me, that's part of that overall thesis that I've seen of extreme bullish sentiment, euphoric, if you will, and then the bearish divergences that have come after the new year, which to me indicate some price weakness, some momentum weakness. That's what concerns me. Now, the name exposure index has come down quite a lot, so it's still 50% long. Last week it was a little higher. The week before it was lower. So we're sort of chopping around in a volatile period. The Ridex flows have actually gone back a little more positive or lower on this chart, which is alleviating a little bit of that euphoric signal. So the way I would describe this chart is they have been really euphoric there in the first 6 weeks of the year. I think that's come off quite a bit, indicating a lessening of the euphoric sentiment. Finally, we'll finish with the put call ratios, and I'll look down here, the equity put call ratio here, CPCE. Back above, there were earlier there in the January and February peaks. It's worth noting the put call ratio was much, much lower, indicating incredible bullishness on the side of options investors. We've actually gone a lot higher in this recent one. This is a little different look. This is actually less negative than I would have considered it. Usually it's a contrarian bearish signal when this reading is very low. We're actually not near those super low levels anymore. So it's sort of alleviated that condition, not as euphoric as it would have been. So overall, to summarize the readings that I saw in the sentiment, I think some things still euphoric. The AAII survey, I think, has increased to the upside, which is similar to previous tops, but also previous periods where we've had extended bull runs. Other ones, the momentum has come off a little bit. As always, I would validate what we just talked about with price and with breadth. We need to wrap the show. Go to the 3 and 3 charts, 3 minutes. Here we go. Chart number 1 is the AAII bull bear spread, and particularly highlighting the bullish sentiment here. We just talked in getting sentimental about the euphoric conditions. The fact that we have over 50% bulls tells me it does not guarantee a top. Don't believe me when I say that. But what it does tell me to do is be on heightened alert for signals of a price breakdown. I think some of the distributive patterns we've seen and momentum divergences might be part of that. Chart number 2 is the financial sector. We didn't talk a lot about financial stocks, but this trend line, taking the low from October, lining up with the low from the end of January on the XLF, lines up almost perfectly with today's low. We actually came down to that trend line, and I set this up and said, all right, as long as we remain above this trend line, things aren't that bad, and we've actually bounced, had a nice bullish engulfing pattern off of that trend line today. So we're getting a bit of a tradable bounce today. We'll see what happens tomorrow, but overall, this trend line I will continue to have on that chart of the XLF, and I'll be watching it closely. So while financials are coming off of a weaker place, what has been working, consumer staples closing, making a new 52-week closing high today, breaking out of this congestion range, while other things that are more traditional offense have not been breaking out, are sort of in a pullback scenario. And the question is this a dead cat bounce before the next leg lower? Consumer staples, quite a defensive sector, actually breaking out, and on a day like today, pushing to the upside. So it may be worth digging into that sector, looking at some of those charts to see whether they're able to break out. Charts like GIS come to mind. Folks, that is our show for today. Thanks so much for joining us every weekday for the final bar. Special thank you to Doug Busch from ChartSmarter joining us from the New York area. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.